Hey everyone, welcome back to the channel. If you're new here, we dive deep into personal finance and economic news to help you make sense of what's happening in the world and how it affects your wallet. Today, we're tackling a huge topic. The US job market is sending warning signals, and it's putting massive pressure on the Federal Reserve to cut interest rates. Could a rate cut be just around the corner? And what does this mean for your mortgage, car loan, or investments? Let's break it all down. First, let's talk about the big news shaking up the markets. The August 2025 jobs report dropped recently, and it was a shocker. The US economy added just 22,000 non-farm payroll jobs. To put that in perspective, economists were expecting 75,000. That's a huge miss. On top of that, the unemployment rate ticked up to 4.3%, higher than the 4.1% we saw a month earlier. And if that wasn't bad enough, the Labor Department revised down job numbers for the previous 2 months, meaning the economy has been weaker than we thought. This is a big deal because the job market is one of the key indicators the Federal Reserve watches when deciding what to do with interest rates. So, what's going on here? Why are the job numbers so weak? Well, there are a few things at play. For one, high interest rates have been squeezing businesses and consumers for a while now. Companies are hiring less because borrowing money to expand or invest is more expensive. At the same time, consumers are spending less as they deal with higher costs for everything from groceries to car loans. This creates a vicious cycle. Less spending means less business revenue, which means fewer jobs. Add in global economic uncertainty, think trade tensions and slower growth in places like Europe and China, and you've got a recipe for a cooling US job market. Now, let's connect the dots to the Federal Reserve. The Fed's main job is to keep the economy stable, balancing two big goals: keeping inflation in check and supporting full employment. Right now, inflation is running at about 2.8% annually, according to the latest core PCE data, which is the Fed's preferred measure. That's above their 2% target, but it's not spiraling out of control like it was a couple of years ago. On the other hand, the weak jobs data is raising red flags about employment. When the job market starts to wobble, the Fed often steps in to stimulate the economy, and one of their go-to moves is cutting interest rates. So, are we about to see a rate cut? The markets sure think so. Based on futures trading, there's now a 50% chance the Fed will slash rates by 50 basis points, that's half a percentage point, at their next meeting in September 2025. That's a big move, often called a jumbo cut. Others think the Fed might play it safer with a smaller 25 basis point cut. Why the debate? Well, the Fed's in a tricky spot. If they cut rates too aggressively, they risk letting inflation creep back up. But if they don't act fast enough, a weakening job market could spiral into something worse, like a full-blown recession. Let's talk about what's driving the Fed's thinking. Jerome Powell, the Fed's chair, has been crystal clear: their decisions are data dependent. That means they're laser focused on numbers like the ones we saw in the jobs report. The fact that job growth was so weak and unemployment is creeping up is a loud signal that the economy needs a boost. But there's a catch. Wage growth is still pretty solid, at 3.7% year over year. That's good for workers, but it could keep inflation sticky because higher wages can lead to higher prices as businesses pass on those costs. Plus, there's the wild card of trade policies. The Trump administration's new tariffs are raising costs for businesses, which could push prices up even more. This makes the Fed's balancing act even tougher. Now, you might be wondering, what does all this mean for me? Great question. Interest rate changes ripple through every corner of your financial life, so let's break it down. First, let's talk about borrowing. If the Fed cuts rates, it'll likely mean lower interest rates on things like mortgages, car loans, and credit cards. For example, let's say you're looking to buy a house. Right now, the average 30-year fixed mortgage rate is hovering around 6.8%. If the Fed cuts rates by 0.5%, you could see mortgage rates drop closer to 6.3% or lower. On a $300,000 mortgage, that could save you about $100 a month. That's real money back in your pocket. Same goes for car loans or refinancing student debt. Lower rates mean lower monthly payments. But there's a flip side for savers and investors. If you've got money in a savings account or bonds, a rate cut could mean lower returns. High-yield savings accounts, which are paying around 4.5% right now, might dip closer to 4%. That's not great if you're relying on interest income. And for bond investors, lower rates mean new bonds will pay less, though the value of existing bonds could go up, which is a silver lining if you're holding treasuries or corporate bonds. What about the stock market? Rate cuts are usually good news for stocks because cheaper borrowing fuels business growth and consumer spending. Sectors like tech and consumer discretionary tend to rally when rates drop. But here's the catch: if investors think the economy is weakening too fast, they might get spooked, leading to volatility. We've already seen the S&P 500 wobble after the latest jobs data, so expect some choppy waters ahead. Now, let's zoom out and talk about the bigger picture. A cooling economy could make it harder for the government to manage its massive $33 trillion debt if tax revenues drop. Lower interest rates might ease the burden by reducing borrowing costs, but they won't fix the underlying issue of ballooning deficits. This is something I'll dive deeper into in a future video. So, what should you do with all this information? First, don't panic. The economy isn't collapsing, at least not yet. The job market is weaker, but it's not in free fall. Wage growth is still decent, and consumer spending, while slower, is holding up. That said, now's a good time to take a hard look at your finances. If you've got high interest debt, like credit card balances, consider paying it down before rates drop, because you'll save more on interest now. If you're thinking about buying a home or a car, you might want to wait a few months to see if rates come down. And if you're an investor, keep an eye on sectors that do well in a low-rate environment, but don't bet the farm. Diversification is your friend. For those of you planning your budget, a rate cut could mean a little breathing room, but don't expect miracles. Inflation is still above the Fed's target, and everyday costs like groceries and gas aren't going away. My advice? Build an emergency fund if you haven't already. Aim for 3 to 6 months of expenses. If the job market keeps slowing, having that cushion could be a lifesaver. Before we wrap up, let's talk about what to watch next. The Fed's September meeting is just weeks away, and all eyes will be on Powell's speech. Will they go for a bold 50 basis point cut, or play it safe with 25? The next jobs report and inflation data will also be huge. If we see another weak jobs number or if inflation cools off more than expected, the case for a bigger cut gets stronger. I'll be covering all of this on the channel, so hit that subscribe button and turn on notifications so you don't miss it. Alright, that's it for today's deep dive. What do you think about the jobs data? Are you worried about a recession, or do you think a rate cut will save the day? And how are you preparing your finances for what's coming? Drop your thoughts in the comments. I read every single one, and I love hearing from you. If you found this video helpful, give it a thumbs up and share it with someone who needs to hear this. Stay smart, stay safe, and let's keep building wealth together. Thanks for watching, and I'll see you in the next one.